Hi everyone, my name is Alexandra Peters, and today I'll be kicking off our presentation for Group 3 on Oracle's potential acquisition of Sun Microsystems. During any merger acquisition, the first question that we really want to ask is this a good fit? And when we try to answer the question of is Sun Microsystems really a good strategic fit for Oracle, the short answer is yes. Oracle is a leader in software, supplying software enterprise information management systems, including relational databases, middleware software, applications, and other related services in the industry. At the same time, Sun Microsystems is a leader in hardware, providing products, services, and support for building and maintaining network computing environments. This includes software platforms such as Java, Solaris, and MySQL. So when we look at some existing commonalities between the company, which already show that they'll be a good fit, Oracle already uses Java and Solaris, so they're familiar with the programs that Sun really leads the industry in. Additionally, some commonalities are that they exist in similar industries for similar consumers and customers. While there is a significant overlap, and Sun does have some smaller customers, while Oracle's on the more expensive side, they can really utilize this and integrate it between the two. Sun also has the potential where Oracle can create immense value add by improving Sun's efficiency. This would be done by cutting outdated product systems, streamlining product lines, and introducing synergistic systems. Oracle really deems themselves professionals at trimming the fat off of companies, and they can really utilize this to increase Sun's margins, increase their customer base, and create more cash flow for everyone involved. So from a strategic standpoint, the greatest benefit is that there is really potential for a high-quality, seamless integration of consumer products of both. So the acquisition will create a full system using Sun's enterprise systems and services with Oracle's software information databases and applications. They can really provide an all-in-one solution for the business customer, which will minimize the customer setup process. So the new potential for both of these technologies will combine Oracle and Sun's benefits and really have the potential to create a transaction processing database machine that will run twice as fast as its predecessor, with a high probability to even run faster than their main competitor, IBM's machines. So really, since we've already considered this a strategic integration from a business standpoint, we use the market and income approaches to analyze the financial value of the deal.
We first tried a market-based approach to evaluating Sun Microsystems. The economic rationale for this analysis tells us that identical assets should sell for the same price. To compute the multiples valuation, we needed to define what companies are comparable to Sun Microsystems. Companies such as Apple, IBM, and HP are simply not comparable to our target and therefore cannot be used as part of our analysis. To be comparable, firms need to be similar in terms of risk, profitability, and growth. When we look at Apple, IBM, and HP's financials, we see that their stock prices, debt, market cap are just very different from our target. Even their net sales, which will play a key role in our analysis, is far greater for the most established bigger tech giants like Apple, IBM, and HP, and therefore we have ruled them out as not being a good comparison when trying to identify Sun Microsystems valuation. So we identified the following comparable companies based on those same metrics that were most like Sun Microsystems, and those included Advanced Micro Devices, NetApp, EMC, and Adobe Systems. Next, we computed multiples, and a comparison was established between the peer group's market capitalization and share price and those of the target companies. In this context, where a company wants to acquire another company, corporate executives are interested in assessing a target's total value, reflecting both debt and equity. In this case, the enterprise value is a better basis for the valuation. That way, we use the EV divided by EBITDA ratio, which resulted in a meaningless value for Sun's EBITDA as it is negative. EVs divided by sales ratio should then be used. And in doing so, Sun Microsystems' EV sales ratio raised the firm's valuation quite a bit, and therefore also its stock price, with a final price of over $44 per share. Now, we know that using just one financial indicator to evaluate a company is not the most concrete way of doing it, so we got a bit creative and looked for other ways that we can compare against the market. And what better indicator to judge volatility compared to its peers than the beta? If we look at the beta for all 4 firms and compare it against our target's beta, we can see that all 5 betas are over 1, which indicates that all of these companies have much more volatility compared to the broader market, which gives us more faith in our comparable analysis, but the risk of investing is higher.
So the other approach we used for our evaluation was the income approach, specifically the discounted cash flow for free cash flow to the firm. So we first wanted to determine the rate of return that Oracle should target for the acquisition by calculating the WACC. So in the bottom on the left, that table, you can see various parameters that we use to calculate our WACC, which we found to be 12.03%. So we'll be using that next in the DCF model. So the top left of our table is our DCF model. The first 3 rows were all given in Exhibit 14. The net operating profit after tax was then found by multiplying the given EBIT by 1 minus the tax rate of 35%. The depreciation minus the CapEx is just equal to the ending net PPE minus the beginning net PPE. To find the net working capital change, we had to do a forecast. You can see that in the table on the right. That was done by assuming a net working capital and sales assumption of 25.9% per year. The initial 2009 value was found using Exhibit 9 to find just the differences between the assets and liabilities. Next, the annual FCFF was found by just summing the previous 3 rows that I mentioned. After finding that, we could then incorporate the terminal growth rate and the WACC that we previously calculated to find a terminal value of $5,529 million. And finally, the total FCFF was just found by adding that terminal value that we just calculated to the annual FCFF to get $5,910 million. So next, we wanted to use this to find the enterprise value, which was found by the sum of the equations involving the FCFF terminal values and WACC. You can see in the table for from 2010 to 2014 to get a overall enterprise value of $3,962 million. Having that calculation, we were then able to get our equity value, which is simply that calculated enterprise value minus the total debt and cash investments that were given in Exhibit 9. To get a equity value of $5,766 million. To find the specific equity value per share, we just divided that by the equity value, or divided the equity value by the shares out price that was given in Exhibit 9 to finally calculate a share price of $7.81.
During our sensitivity analysis, we were able to identify and confirm a terminal value in between 4 and 5, but a little closer to 5, being more accurate, while using a WACC of 12%. This confirms our equity value per share of $7.81 that we calculated in our discounted cash flow approach that shows our terminal value of 4.8. We were also able to identify the company's future cash flow, their information advantages, and their elimination of competition via acquisition as their most effective synergies. These synergies positively affect the enterprise value by enhancing internal processes and financial engineering via revenue enhancements and cost savings. The lower the WACC is, it will allow for a lower break-even cost. The reasoning behind the positive effect is that these are 2 industry leaders merging to become one. In doing so, their processes will merge to create one process that will hopefully uphold, if not enhance, the current revenue streams of each company. Also, in doing so, it will highlight ineffective cost strategies that can be eliminated in the future post-merger in order to save on costs. That is how our synergies will justify the premium that we have agreed upon. Which leads me to my next point. Should a competitive bidder appear, we all concluded that the company should be ready and willing to offer up to 40% of the premium of the equity value per share. With our calculation showing an equity value per share of $7.81, this means that they should be prepared to offer up to $10.93 should a competitive bidding war occur.